Welcome to the Golden Experience, and we are here today with Rasheen Bennett. He's been on the show before. He's in Texas. I affectionately call him the Tax Man. He has gone through certain trainings and levels of education where he is doing taxes, able to do taxes. He has certain clearances from the IRS to speak on certain things, and he has those levels of credentials. But I am going to stop talking and let him tell you what he does. This is for 1099 workers. I'm going to be doing a tax series on taxes, because this is tax season, of course, to help people out, not just 1099, but regular person, and what we can do during the year to maybe offset our taxes and get all our money during the year, things like that, things we can do, things we can help. Also, Rasheen can help you with that. There ain't no hookups, but he gonna make you we gonna make your tax work. There's been a lot of entrepreneurs that have started in 2021 because of the pandemic, a record number, particularly for minorities, and you can't just start a business, make money, and not know what to do with taxes, or not know what to do with your money when it comes to the government. And we don't want to get into doing things illegal. We want to do and get into the loopholes that we complain about the rich. And they're not really loopholes, they're just things that we don't know. They're not loopholes. And I think we should correct that nomenclature. They're not loopholes. You just don't know. Just because you don't know, and you don't get to pay $750 in income taxes to be president, don't be mad because he knew and you didn't. But let me shut up. Let him go ahead. Rasheen, go ahead. Tell us who you are, man, and on the tax tip.
Yeah. Rasheen Barnett, owner and founder of Kingdom Tax and Associates, where I'm an enrolled agent. So people always ask me, what in the world is an enrolled agent? So, excuse me. An enrolled agent is someone similar to like an attorney or a CPA, has unlimited practice rights, which means unrestricted to which taxpayers I can represent, which tax matters I can handle, excuse me, and which IRS offices I can represent clients before. So like, anybody can prepare taxes. Technically, you could get on irs.gov right now and apply for a P10 number, and in 5 minutes you can get a P10 to do prepare somebody's tax return, right? However, an enrolled agent is a lot more. There's tests you have to take, all type of things, and continuing education that you have to go through to maintain your knowledge of the tax matters. You're considered like a tax guru, right? So I like to explain it to people like this. Most people use the word accountant or CPA, right? So generally a CPA, they don't just do taxes. There's a myriad of things that CPAs handle. Taxes is just one of them, right? Whereas an enrolled agent is purely a tax specialist. So here's the analogy that I give people. If you had an issue right now in your body, after a couple of days, you might be like, man, I need to see a doctor, right? So you probably go to your general practitioner first. Say, hey, doc, I got this pain in my side, yada, yada. They'll triage you. They'll maybe give you some medication or tell you to go do bodily sleep. You go back 2 weeks later, you're like, doc, I'm still having this problem, right? So your general practitioner handles all type of issues. But if you still have that same problem and they think you need a different level of expertise, they'll send you to a specialist that only specializes in that one vertical of things. So synonymously speaking, an enrolled agent specializes in tax matters and has representation rights. So when you get that letter from the IRS saying, hey, we're going to audit you, you are entitled to representation. So I would not go at it alone. Find somebody who can represent you, and those credentials allow me to represent taxpayers before the IRS.
Awesome. That is very interesting because I used to work for Social Security, and Social Security has you can do the same thing to be a Social Security to represent people, to take a test, and you become, officially I can represent people for Social Security administrative law judges. A lot of people use attorneys, but you don't have to have an attorney to do that. So it's kind of that's kind of interesting how that's the same. But I do want to say this. I had mentioned on a previous show that 1099 workers and taxes would go up by 15%. Of course, the official tax agent here checked me hard, and I tried to come back with everything to throw at him at the kitchen sink. He was so humble about it on the show, but on the phone, he was giving me the business. So that is not the truth. Your tax is not going up by 15%. However, what is the truth is the tax threshold before there is a tax increase went up, I believe, about $7,000 from 135 to 148. So if instead of being taxed at a certain rate at 130, 135, you're going to have to make up to 148, I believe. Don't quote me on that, but it is 140 something before there's a tax decrease or a tax drop off. So in the technical sense of the word, your taxes could have gone up. The threshold is just higher. But that was not the case in the truth. But again, saying something, because I heard something like that and I still haven't been able to find it. And I don't think the person said it maliciously. But then again, it's always good to, saying something wrong like this is always good because I've been privy to the resources of a tax agent to correct some of the things like that. And so it proved to be good from the standpoint that there's someone who actually knows here, and this gentleman is not hearsay, he's not the news, he's an actual enrolled agent with the IRS that has to go through continuing education to understand tax code and how to represent people. So if there's any tax questions you guys got, please put it ask it in the comments, and I'll ask Rashim if you come back to the video and you see anything that people have questions with, you get in contact with them. And if you do need somebody to help you enroll, this is statewide, right? Rashim?
Across the U.S.
Across the U.S. and I'm assuming that they're doing video, so that you don't actually have to be in the same place.
Yeah, I have clients all over the U.S. Clients in California, Texas, Michigan, Florida, Georgia, everywhere.
Mm-hmm. All right, so let's just dive into it. This is about 1099. I am a 1099 worker, not worker, but 1099 self-employed, and I get my money in cash, all of it. Give all of my money. They're giving it to me. And I'm spending it on my expenses. And I'm recording my expenses. One of the things you told me as 1099, make sure you get an app that tracks your mileage. Because, and go ahead and tell them why you need an app, or you need to at least take a picture of your odometer.
So I told you to get the app. I highly recommend that, right? And here's why. Multiple reasons. One, you can deduct the mileage that you drive for business reasons, and the number changes every year. What that is, I think like 58 cents a mile or whatever, against your income, right? So it's important that you take copious notes, and an app would help you do that, because people just jump in the car all the time and go. So there's some apps out there like Mile IQ is a great app that is connected to your phone, and it senses when you're moving, right? And it'll pop up and ask you like, hey, is this a personal drive or a business drive? And captures the odometer and gives you a spot where you can put the reason of what you're doing, so you have those notes. And here's why I say you want to use an app, is because business mileage is one of the most abused deductions that people take. And so everything is captured when you think about like how do they know that certain businesses are in $1 billion industry or what have you, right? So there's all this information is captured, right? So they know as a Jonathan, as a realtor, the and the state you're in, the metro area you're in,
Mm-hmm.
and the amount of money that you have, generally, how many miles you probably drove to create that kind of income.
Yeah.
So when you put on there, I drove 50,000 miles this year, they already know you out of bounds. But you only brought in $30,000 of income. Like, really?
Right.
You understand what I'm
Yeah.
saying? So you want those records, because I've seen it happen many times. When you don't have those records, if you don't have any proof that you did it, even though you can walk out to the car and be like, look at my odometer, it's greater than what it was last year. But you don't have proof for the reason why you drove those miles, they will subtract those right off your tax return and then charge you back the taxes you owe from what you didn't pay because you deducted it, and a penalty on top of it.
Ooh wee. So what I hear you saying is, and it kind of goes to, if it ain't written down, it didn't happen.
It didn't happen. Exactly.
You gotta have it
Exactly.
written and documented some kind of way.
Exactly.
All right. So moving. We talk about writing things off because we don't want to pay tax. We don't want to pay no taxes, or we want to pay the minimal amount of taxes. And so 1099s, I see it all the time. Making money, got money, got assets, got cars, house, all that. I want to get approved for a loan somewhere. But guess what? You showed that you made $2.50 last year with your Benz and your gold watch, and wife got a ring, and you went on trips to Turks and Caicos. You done all of that, but off of $2.50, you ain't you ain't finna get approved for a watermelon.
No.
So what do we got to do, man? Because we ain't listen. What do we got to do? How do we balance that? Is there a middle ground with that? Because you can't get approved for a loan. Not even small. I don't even know if you can get approved for a small business loan.
Yeah, so that's a really convoluted question.
Let me piece it up. Do we need to stop writing everything off and show income? And if we do, how do we do it?
So first and foremost, there's a couple things. One, there are loan products out there for self-employed individuals that may not meet certain requirements for standard underwriting.
Are
That's
they
a whole other
forgivable?
conversation.
We'll get to that. We'll get to that.
Yeah, whole other conversation.
So let's have that conversation. Small business loans. We'll do that the next show. But they are out there. They are out there.
They are out there.
Mm-hmm.
But keep in mind, like, you should really only be writing off things that are true expenses, right, for your business. Right? Because what you also don't want to do is, you don't want to be in a position, especially if you're looking to purchase a home or a property or something like that, you don't want to be in a position where you create mortgage fraud. And that could be easy to do, right? So for example, generally mortgages, they want you to have 2 years of tax returns.
Yep.
And they average those two to determine what your income would be, the viable income that can handle this mortgage for your DTI, your debt to income ratio.
Mm-hmm.
Right? Well, I've seen people, unfortunately, go and redo their taxes in previous years to try to show the income so they can get a mortgage. That is mortgage fraud.
Wow.
Right? That is. Or what they will do is, knowing they're going to buy a house in 2 years, for the first 2 years, not claim any expenses, so they have, it's really all revenue.
Yeah.
But it's not your true income.
Right.
To get the mortgage, and then afterwards go back and try to reduce. That's mortgage fraud.
Yeah.
So we got to stay away from that.
Yeah.
One key thing we got to think about too is, when you're in business, you almost have to look at it like, if you were employed somewhere, they're going to give you a salary or a wage or whatever, take the taxes out, and whatever you have left, that's what you got to go spend. So just because you're in business yourself, if you're making earned income, there's going to be taxes to pay. right? So if we want to reduce our tax liability, we got to shift more of our efforts to get a more passive income. That's one of the key things, is more passive income. Passive income is, especially in real estate, depreciation, things of that nature, allow you to make that cash flow tax free, right? And so there's some advanced techniques we can talk about that.
Yeah, cash flow. I remember you were saying something. Cash flow is not taxable. It's not income.
It is, but when we say that, it's more of like, it's the depreciation on the asset that offsets the income, the cash flow that you have, which makes it not taxable. So it's not that it's technically not taxable. It's just the depreciation offsets the income.
I got you. So what if I've heard this. A friend of mine said, man, when you get a lot of money, whatever, spend it on assets.
Yeah.
Put it into assets.
Yep.
No, so if I get a lump sum of money, I hit it big like next month, right? And I bring in that's where I'm gonna go. So walk me through this. I hit it big, 50 G's. I get,
right, so here's a real world example, right? So let's say you take that 50 G's and you put that 10% down on $500,000 property. Okay? Well, if it's a residential property, the government requires you to depreciate it over 27 and a half years. So get out your calculator if you need to. 500K divided by 27 and a half gives you $18,180. So we're talking about one property so far, right? So that's the depreciation you're going to take each year for the next 27 and a half years on that property. Now, let's say that property cost you $2,000 to maintain. You got mortgage on it, you got some taxes and interest, it costs $2,000 a month to maintain. But you rent it out for $3,500 a month. So you got $1,500 in positive net cash flow each month. Well, 1,500 times 12 is what? $18,000. So the depreciation just offset the cash flow that you got coming in. So your tax bill is zero.
But you got cash flow and it shows income, and you can get approved for something.
You can.
Oh, so okay. Put your money in. So somebody, I've always heard that Michael Jackson was asset rich and cash poor.
Yeah, so a lot of his assets they weren't income producing assets. Right? You might have vintage cars. They'd be considered an asset because the value doesn't necessarily fall, right? And you might, it might have more value than the liability against it, but it's not producing any income. So you can be asset rich, yeah, but cash poor. Right? So we want to invest in assets that are income producing.
Okay.
That's one of the key things.
All
Absolutely.
right. So what's another question I had about 1099?
I can tell you a lot of things. Here's one thing that people can do if they're self-employed. And especially if you own the business either yourself or with your spouse. That's the only way you can do this. Right? Get yourself a solo self-directed 401k.
I have one of those with Chase, and I didn't pursue it. I didn't know what the heck it was, what I was doing. But go ahead, talk to us about self-directed 401k. Go ahead, talk to me.
Yeah, so they call it a self-directed solo 401k. Okay, and here's what it allows you to do. So let's take somebody who works and is a W-2 employee, right? Your job might offer a 401k plan, but the government limits the amount of money you can put in that 401k at $19,500. Okay, and I think next year it's going to be 20, whatever. It varies. It's about 20 grand. Okay. Now, if you are self-employed and you have a self-directed solo 401k, you in essence are the employee and the employer. So you can put away that 19.5 elected deferral like you can as a W-2 employee, but also you can put away 25% of your net profit in that vehicle as well, up to a total of, for 2022, $61,000 a year.
I heard
really what you're doing is almost like a profit share putting into the 401k as the business.
Yeah. Now here's my question with that. You said it's defer that. So it's deferred to tax deferred to when I want to withdraw it out. So they're going to tax me when I draw it out.
Yes.
So how does that? So because the money isn't taxed yet.
Yeah, it works the same as the standard 401k.
Okay.
The difference is the amount you can put away.
Right.
Again, because you're self-employed, you're the business itself.
Right.
So you can put away 25% of your net profit up to a total of $61,000.
Okay, so that's a self-directed 401k solo.
401k, yes.
Solo 401k.
Solo 401k.
Okay.
Now, here's the benefits of that. If you're married, now you can't have any other full-time employees. You can have other contractors. You can have part-time employees. They can't work more than like 1,000 hours a year or something like that, right? So you can't have any full-time W-2 employees. But if your wife works in the business with you, you can put away double because both of you can put away that 61K, right? So that's a lot of money you can put away tax-free, right? And in this type of account, you generally have what they call checkbook access. Now, here's the value to this. If you're working at an establishment, that 401k is you're generally limited to stocks, bonds, mutual funds, ETFs, whatever is in that that financial vehicle that you're using. But in a self-directed, that's why they call it self-directed solo 401k, you can invest in anything. So you can buy your real estate with your self-directed solo 401k. You can invest in crypto. You can invest. If Jonathan, you said to me, hey, Rasheen, I got this great business venture that I want to start. Will you invest in me? I can pull it out of my 401k and invest in your business. Right? Now what happens is all the proceeds that come out of that, the profits that come out of your business or cash flow that comes out, if you invest in real estate, the monthly rent that comes out of it, the positive cash flow, it has to go back into the 401k. That's how it grows.
Okay.
Right?
Okay.
So no different than if you invested in Disney stock, which has dividends, right? Those dividends, you can't pull it out your 401k, you'll be taxed on it, right? But they just build up your amount of cash in your 401k, right? So same way if you invest in real estate, the monthly rent that comes in goes into your 401k, right? And then you go buy more properties with it. Now here's the other benefit. It has what I call checkbook access. So in your standard 401k at your employer, you can take loans out against it, right? Or you can withdraw money. You'll be taxed on it, though, right?
Yeah, but for property, they don't tax you. You can take it. But for if you're buying it for the purposes of purchasing property, I thought they didn't tax you.
You have to be a first-time home buyer.
Oh, okay, all right.
So there's some limits there, but you're correct, right? But there's some limitations to that.
Okay.
Or if you're like, you can prove you're in financial distress or something of that nature, right? They'll allow you to pull it out. Then you have to put these exclusions on your tax return to show that this is why I'm doing this, right? But nonetheless, if you go to your employer, let's say it's Fidelity or Charles Schwab, whoever is holding on to that money, it might take you 5 to 7 business days to actually get the money out, right? Well, if you have a self-directed solo 401k with checkbook access, you literally pull your checkbook out and you write a check. It happens, right? So imagine negotiating a real estate deal and you both get to the number that you're happy with. It's like, shut up and take my money and write you this check right now.
Gotcha.
Right? So it gives you a little bit of an added advantage in negotiating as well.
So what else for 1099 can we do, man?
You could also do a SEP IRA. That's another option, right? So it works similar to the solo self-directed 401k. Has very similar limits as well as far as how much money you can put in it. The difference, though, is a SEP IRA does not allow you to have that 19.5 elected deferral, right? So you can still put away 25% of your net profit away in it, but because it doesn't allow for elected deferral, the 401k plan, if you put the same money in over the same period of time, will grow faster. So those are some key things. One of the major things is get your accounting together. Man, I don't know how many people that and I don't know what it is. Maybe people get so excited about having their own business that they're trying to make money and they're trying to pay themselves first, which I understand you want to get paid in your own business. But the problem is you got to build the business. You don't want to be working it forever. You want it to work for you, right? And so what I see is people like leaving their jobs to start their business, and now they need that income from their business to go and survive, pay their car note, pay their house note. But I would tell people, if you have a job and you're trying to start your own business, keep this job until you can get things in order. Get your accounting in order. Get your marketing in order. Your advertisement. Get people that's working. You want to build something that's scalable, right? So that it's working for you, and over time you get to walk away, right? And so many people are so trying to move so fast and not realizing that assets. A lot of things build up over time. But that's one of the key things, not having your books in order, because when you don't have your books in order, you don't know what you're writing off. People, all they know is, oh, I got my car, I got this, I got that. But there's certain ways and strategies that you can use those expenses to work for you on your behalf, right? But one of the major things I would highly recommend is any self-employed individual, you have to get some income-producing assets on your side, right? So that you can start building that wealth from the cash flow of that and gradually get away from earned income. Earned income is always taxed at the highest rates possible, right? Capital gains are lower rates. But even then, if you have an income-producing asset, when are you selling that asset? Not. So that's why I think it's a joke when like Joe Biden's like, oh, I raised the capital gains rate. Well, most wealthy people aren't selling their assets because it's producing cash flow. So effectively, you did nothing. If you don't pay capital gains tax until you sell it.
Until you sell it, yeah.
Right? And even then, they're going to use a 1031 exchange, move it over to another property, and just defer those taxes forever until they die. Then it doesn't matter then at that point.
Wow. They put something on. That's not a loophole. That's just...
No, it's just the law.
It's just the law.
So I like what you said about loopholes. People always talk about loopholes. And I tell people, no, this is like a sports game, man. The more you know the rules, the more strategic you can play the game.
Yeah.
But just because you don't know the rules don't mean it's a loophole.
There you go. That's going to be the headliner for this show. It's only a loophole because you don't know.
Right. So speaking of that, here's some other things you can do, right? So depending on how much income you have, it may be time to go buy a vehicle.
That was interesting. I was working for a gentleman, self-employed, and his accountant literally said, you need to buy a vehicle or you're going to lose money. I was like, what?
Yep.
Go ahead, man.
Listen, you either going to pay yourself or you're going to pay Uncle Sam, but you're paying somebody.
That's exactly what his accountant said. It's either you going to pay you or you're going to get that money to Uncle Sam.
You're going to spend it.
Yeah,
right?
Yeah, it's going somewhere.
Go get you go get a vehicle that you can depreciate within 1 year. A vehicle over 6,000 pounds. That's why you see so many Range Rovers out here. Not just because people really like them. They weigh over 6,000 pounds.
Oh, boy, you dropping nuggets on us, bro.
So I can accelerate the depreciation and write off the entire car in 1 year. Right? No matter how you purchased it, the government don't care if you finance the car, pay cash, whatever. You can finance the car, but the value of that car, it's a $120,000 car, you just...
It makes sense because the car that this gentleman got is a big Cadillac.
I got the autobiography.
Escalade.
6,600 pounds, or Escalade.
The big Escalade. And I was like, man, why you always getting this? And it makes sense. It has to weigh a certain amount. Wow.
Here's the thing. You got to have the income
to
support it, right? You're not going to write off a $120,000 brand new Escalade and you only got $50,000 showing $50,000 in income.
Right, yeah.
You got to have the money to...
Right. It's got to make sense, of course, yeah.
But if he was, bringing $120,000 net profit, right? And you either going to pay Uncle Sam that probably about $30,000 to taxes, or you going to go buy you another vehicle.
Right.
You can choose, right? Yeah. So, and again, this vehicle is for business purposes, right? So this is not your personal runaround vehicle,
Right.
but right. So that's a major thing that people can do, and the government also has a list of vehicles for you to choose. See, this is how you know it's not a loophole, right? The IRS has a list of vehicles that they know of. Now, all of them ain't on there because manufacturers are always building new stuff, but they got a list of vehicles that are over 6,000 pounds, and right, the Jeep Grand Cherokee, over 6,000 pounds. So you don't have to be balling out of control. Go get your $50,000 vehicle.
That's interesting, man, because I just started my LLC and did the articles and paperwork, and they were asking me a list of questions, and I ran across a question. They were asking me, "What is the I don't know, because they asked me about the weight of the car." I was like, "Are you going to buy a car that's over a certain pound?" I was like, "Why are they asking me that?"
Well, that's for a totally different reason.
Okay.
Yeah.
All right. I wondered if that had something to do with it. Yeah. Okay.
No, that's for a different reason. So those are things you can do. The other here's something that you can do. How old are your kids?
They are 17 and hold on, 17 and 14.
Perfect. Now think about this. All right, I'm gonna go with this slow because it's a lot to capture. But think about this. Right now, you bring home money. Whether we can help you with your taxes or not, that's neither here or there. But let's assume you got to pay some taxes, right? You bring home some money, and then you go and your kids need new shoes. They need new clothes. They need whatever they need. Gifts, toys. You're paying all this stuff with after-tax money.
Right.
Right? Now, your kids, you can hire your kids.
Come on, talk to me.
Okay?
Talk to me.
And because they're your children, you're responsible for them. There's no workers' comp that's assigned to it. Right? So you eliminate that portion of unemployment because they're your dependent. They're depending on you anyway. Right? But you can hire your kids to do. Now they have to do actual stuff in your business, right? And you pay them a benchmark wage, if you will, right? You can't be paying a 2-year-old $50,000 a year. It just don't.
Right. Yeah.
You understand, right?
Right.
So you find jobs for your kids to do. Now they can make like $12,500 a year tax free. Right? So they fit under the standard deduction. So instead of using after-tax money to go buy your shoes, buy this, buy clothes, buy food, whatever, pay your kids to do a job for you. Again, you're going to pay somebody or you're going to pay Uncle Sam. Right? Pay your kids to do a job for you. Now, what you paid them is a deduction to your income because you paid it out as an expense.
Right.
But then also, now they can take that money and go buy the shoes they want, the clothes they want. You was going to spend it anyway. But we're just shoving it through the kid now.
Right. Gotcha.
Now, when they do their tax return, they're going to get all that money back. All the taxes that you would have paid them or paid the government on their behalf. Now, you can't cross over the threshold, right? You can start owing some money. But standard deduction is $12,500. So that's one way to save on your tax money and still get your kids everything they need.
Good. That's some good stuff, man. I don't want to belabor past this. I think we reached a good saturation, and I just want to thank my viewers out there, for my listeners, for listening to the Golden Experience. We're going to delve more into this whole tax thing. We're doing a whole series probably for the next 4 weeks on it, and just some things we need to know. And Rasheen Barnett is a tax agent, right? Or IRS.
Enrolled agent.
Huh? What's that?
Enrolled agent.
Enrolled tax agent. And so he is the expert on the subject. If you have any questions, people, hit me in my inbox or on the comments. Put it in the comments, and hopefully, Rasheen, we can put your questions on the show, or Mr. Barnett can answer your questions there, and we go from there. Thank you for watching, and God bless you.